It really feels like with CAF and also with its bigger brother, older brother, I don't know what you call it, but cows, that you've really captured lightning in a bottle here. I mean, you take a look at the flows, CAF in particular taking what, close to $3 billion so far this year. I guess my first question would be, who is buying into this fund? Is this retail players that, have found this fund, or are you getting that institutional crowd as well?
No, thanks for having me. It's good to be here. It's good to see everybody again. We focus on the financial advisors. So our flows come from financial advisors, Merrill, Morgan, Wells, UBS, LPL, registered investment advisors. You said lightning in a bottle. 8 years or so ago, and we sort of had this idea that we wanted to redefine what value was. Traditional value forever had been like low price to book stock investing. The stock market's changed a lot. There's not much tangible book value left. It's all intangible assets that drive prices. And so by disconnecting from that price to book and inserting free cash flow yield, which is just a different way to measure the value of a company, we launched a whole series of ETFs on a theory, if you will, that have actually delivered exactly the kind of returns that we thought. So we've been very, very fortunate.
You said on a theory, but we're in a market environment in which everyone is prioritizing free cash flow. When earnings reports come out, everyone goes to the free cash flow line. What is it about the current environment that makes investors prioritize this particular metric?
Well, I think you're hearing a lot about it in the ETF world. It probably doesn't hurt that we've got $30 billion worth of assets or $33 billion worth of assets in a series of ETFs that use free cash flow. But it's more a relevant measure of a company's worth today. So free cash flow yield, for example, is the free cash flow a company generates divided by its enterprise value. Just how much am I paying to buy the whole company? If I did that, what would I get in return? And so you can get a better look into what's really going on at a company. And then the other thing that we do that's really kind of important in this process, Eric was talking about CAF earlier, we exclude names in the broad indexes that we draw from, like the S&P 600 or the Russell 1000, for example, that don't make money. And in the S&P 600, 25% of those names don't make money. And so by eliminating the losers, you have a much different overall view for what those companies look like and what your fund looks like. In small cap land, they're highly levered. 30% or so of all of the earnings that are being generated in small cap land now, because the Fed has been raising interest rates, are being used to just pay debt service. So as the Fed has been raising interest rates, it's been harder and harder for small caps. And the other half of their debt is permanent debt. And permanent debt in small cap land is like 5 to 7 year paper. So that's now starting to roll over. So even if we get a reversal from the Fed and they lower interest rates, that other tranche is going to start to pile on at higher interest rates. So we take a slightly different view of small cap. We don't want to own the whole index. We only want to own 100 profitable stocks that have excess free cash flow.
So every now and then people talk about ETFs, owning too much of the market. It's usually not really the case. But here, CAF owns more than 25% of the shares of Central Garden and Pet Company.
Yeah.
There's a couple stocks. It's become almost like a big fish in a small pond, right, with small caps. What's going on there, and will that get unwound at some point? Yeah, I mean, we rebalance, as you know, every 90 days. And so, in CAF in particular, we have to be very, very careful about the rebalance process. We're different than a mutual fund in that if we have to change a name, we're not going to outright sell that stock. And so we've been able to figure out how to work with the market makers in order to have very little price impact when we have a high concentration in the small cap fund in a relatively small name. But you'll see those names change from time to time. And then the other thing that's important, Eric, about this is that there's two things that are different. One is we don't weight by market cap, we weight by free cash flow. And we cap every name at 2% when we rebalance. We're not going to have a 15% position in a very small cap stock.
Well, Eric does raise a really interesting and important point. I mean, when you're talking about the small cap universe, your fund is close to $10 billion right now. And even with that rebalance, I mean, you own such a big proportion of some of these much smaller names. How big is too big? Is that something that you're planning for potentially?
Well, I dare everybody to send us that much money. There's probably a number. I think it's out on the horizon quite a bit because of the way ETFs operate. We can essentially send our whole book to a market maker, and they'll work it for the week for us, as opposed to being a mutual fund where you have to outright sell. So there's probably a number somewhere down the line, but I think we're not even very close to it today.
You talked about free cash flow as redefining value. You also have executives tying their pay to free cash flow. Warner Brothers Discovery's David Zaslav, for instance, reportedly his bonus is tied to free cash flow. What do you make of that, using that as a metric?
Well, earnings are just an accounting function, right? You can make earnings almost anything you want by working all of these different calculations, bringing forward revenue and taking write-offs and so forth. Free cash flow, you can't lie about. It's all of the excess cash that's available at the end of the year from a company after they've paid all of their expenses. And so it's a much better, I think, measurement of how high quality a stock is as opposed to earnings. And earnings, as I said, they can be manipulated. You just can't manipulate free cash flow. And so we think that's probably what's driving it more than anywhere. If I was a shareholder, I would rather have an executive compensated based on the amount of free cash flow they generated as opposed to what they could make the earnings look like from quarter to quarter.